This is our currency meter and Forex blog for October 24th, 2011. And like most days, we really want to buy the strongest currencies versus the weakest, and we want to sell the weakest currencies versus the strongest. The dollar and the yen both have longer term daily, weekly, and monthly trends that are down. So if we see some weakness that comes in there, it's always good to trade real-time weakness when the longer term trend is also in that direction. You tend to have a higher winning percentage from our experience in trading, and you also tend to have bigger pip moves. That weakness also is likely to last longer. So instead of possibly half an hour of weakness or an hour, 2 hours, sometimes you get weakness for 4 or 5 hours because it's in the direction of the longer term trend. The dollar and the yen are the weakest. The New Zealand and the Australian are the strongest. So whenever multiple time frames line up, you can see very extreme strength in the Australian until about 2 hours of counter trend, and then the strength comes back in for an hour, hour and a half of weakness, which gives you opportunities to buy it at a discount, after a pullback, and then the strength comes back again. So this is what typically happens when you line up all the time frame trends. You don't know if the counter trend move will last a half an hour, 15 minutes, sometimes 2 hours, but usually the trend will resume itself if you have incredible intensity. This is our FX Trend Pro, which is made up of 5 of our different statistical trend tools. 3 of them measure the direction of each pair. Is it going up or down? And what percentage of dollar pairs are going up or down? And the other 2 measure both intermediate time frame intensity and bar by bar intensity. And this is set to a 5-minute chart. So anytime you have a plus 80 or higher level of strength, the vast majority of dollar pairs are going down, and they're going down with incredible intensity. And so when you see just about a half an hour of very mild strength right here with very little intensity, that previous extreme trend is likely to continue, and it does here for an hour and a half. So let's say you started trading, you see extreme weakness here, you start trading around midnight, you see very brief amount of strength, you're looking for that to continue the downside, and you have the exact opposite pattern here in the Australian. A lot of intense weakness followed by just about 30 minutes of 1/5 as much weakness as there was strength. So that because the daily, weekly, and monthly trend is up, that trend is very likely to continue. So at 12:30, you'd be looking to buy the Australian dollar. Now, first of all, this currency, obviously trended up, pulled back, went sideways here for quite a few hours, and broke out right here. This was one of the better trades because it wasn't up too much. These are our upper containment bands, the white bands. Usually when price gets near these or above them, it tends to reverse. So in this example here at 12:30, you got this pullback, and you might have went long right here around 99. It came back up and it double topped here. You always have to assume markets will double top or double bottom, and that will be your maximum profit. If it shoots through there, then you hang on to the next level. But this was up here at 21. You only made about 20 pips on that trade, and at 3 o'clock here, notice back on the currency meter, we had weakness. So you might have got into trade here and lost. After about 2 hours of hour and a half of weakness, at 5, the strength comes back in. And this is a good place to buy at the hourly moving average. Whenever a trend explodes up, usually the first and second times it comes close or touches and finds support at the hourly, it's a pretty decent place to buy. You can see if you draw a trend line over the bar's highs, as soon as it breaks that, you go long, and it's not the most profitable trade in the world. The first one, 76. If you use the trailing stop, you're out at 90. You only made 14 pips. You have another pullback right here that went up 25 pips. This pullback right here went from 0.2 all the way up to 50. So this last trade made 48 pips, but you have a small trade here, very small profit here, small profit, but when added together it adds up. And it was the highest probability because the dollar is the weakest of the currencies. And notice from 3 to 7, strength comes back in. So that's why the Australian dollar pulled back. The dollar became really strong, but the longer time frame trend was down, and you're anticipating that trend continuing, which it does, a little bit before 8 until now. Now, when the dollar has some strength here, and you'd want to buy it versus one of the weakest ones, You can see the pound, the weekly trend's down, the monthly trend slightly up. The euro, the weekly trend's much more down. The monthly trend, unfortunately, is quite a bit stronger up. I prefer the weekly trend over the monthly trend. The monthly trend sometimes takes 5 days to 10 or 15 days to change direction, whereas a weekly trend can change in a day, day and a half, 2 days sometimes. So the more intensely down the weekly trend is, if you see weakness in the euro, notice extreme weakness, less strength, extreme weakness, less strength. This is what you're looking for in terms of patterns. Now, I wouldn't necessarily want to be buying the euro, or I'm sorry, selling the euro against the dollar. The yen was clearly stronger than the dollar at 3, and it had very little amount of weakness. And it also has slightly less weekly and monthly intensity down. So, after 3, the euro yen was the better of the two pairs to be looking for. Here's 3. The price is above the hourly moving average. Aggressive traders, when they see incredible intensity on the way down and counter trend move up with almost no strength, they're looking to sell this. And most of the time, the price, when you have intense trends, will work its way down to the first or second Fibonacci profit target. So you're short somewhere around 106, and you always have to be aware that the hourly moving average could be support. So you could have always taken this trade, gotten out right here as it rallied back up again and had very little weakness, gone short again, and then got out of that trade there. So whether you're a longer term trader that gets in and just waits for their profit targets, Fibonacci's make a great one, or just scalping, quick 10-15 pip profit. Second entry here around 105.90, you're out somewhere around 60 or 55 for 30 pips. So you made 10 or 15 pips and then 30 pips. And one of the benefits of using our software is using the range charts. The range charts really give you a clear view of the markets. Most days I leave these running throughout the night. If you put in 6R for ticks per bar, this brings up to 6 pips per bar chart, which means every 6 pips of movement it starts a new bar. It's not time based. If it takes it 10 minutes to do that, 1 bar is 10 minutes. And I'm not sure why it's not coming up. Let me bring it up here. And oh, here it goes. It took it a while. Let's scroll back to around 3 and look at it on a ticks per bar chart. Notice, for scalpers, this is an amazing way of trading. Here's 3 o'clock. You got that little pullback. You can always go short after a 2 to 5 bar pullback. Put your stop a pip or 2 above the bar's high. You can always, get out with about 6 or 7 pips. It's kind of going sideways right here. You're short again. It's going sideways, which is showing support. You get out of that with a small profit. You might have went short here with a small loss. Short again here. Out here when it starts going back up at 84. Short at 04. That's 20 pips. You can also draw trend lines underneath these very well. The more bars it goes up, the better typically. And here is the last swing high to the low, and it makes a great Fibonacci profit target. If you went short here around 3,900, you're out at 60 for a 40 pip win. And scalping on range charts is phenomenal, and you can set this to anything you want. If you're a longer term trader, you can use the 15 pips per bar to get a little bit better feel and see farther back. Notice on the way up, it went up one wave up, pulled back, pretty much another wave up sideways. This is the third wave up. Usually markets move in 3 waves, and the last swing on the way up was from here to here, and look where the market stalled, right? The fib target. Whole and half numbers tend to be resistant. So if you were trading last night and you saw the intensity of the euro kind of running out of steam up here, closing in on 3 o'clock, and the dollar's weakness dissipating, you can always go short there. And most of the time when the market makes such a big move, you can get a 38% pullback. So there's the high. Let's say this is the low of the last 2 days. Most of the time, the 38% pullback right here at 56 is a good profit target, and it's a considerable number of pips likely profit target versus a small, less than 10 pip risk. Let's take a look at the euro yen, which I should have brought up instead. I brought up the euro dollar instead on accident. Once this loads, I'm going to switch it from 15 pips per bar back to 6. The nice thing about using 6 pips per bar is that if you put your stop, 1 or 2 pips above or below, your entry point, you're risking 6 pips plus 1 or 2 pips padding. Sometimes with a spread, you have, under a 10 pip trade. Now coming up to 3 right here, notice on this, you actually have a little bit of sideways action here that you might have shorted, because this also was up quite a bit, statistically too much, likely to have a deep pullback. If you take some scalping trades on there, maybe 12 pips, 6 pips short here, 15 pips. And a lot of times after a pullback, when it goes sideways for multiple bars, up, down, it tends to break out, and you have this nice Fibonacci profit target from this low to the high here. And look where it stalled. So you're short at 90, out at 54 for 36 pips minus your spread. And anytime you take a trade that's likely to give you 2 times, 3 times, 4, or even 5 times more profit than what your risk is, that's the real secret to trading. Trading, it's not complex. You have to be able to be disciplined and patient waiting for trades, and you have to take small losses when you're wrong, knowing that you're going to catch the occasional 30, 50, sometimes 100 pip win. That's going to get rid of a ton of your losses and leave you profits at the end of the day.